Thank you for joining us for our webinar session. Today, we're going to go over the private market secondaries with an ambitious title, Finding Liquidity in Illiquid Asset Class. So today, we have the chance of having Rohan Dutt joining us of Cambridge Associates. He's a senior director and a founding member of the Cambridge Associates Global Secondaries team, specializing in sourcing and executing secondary investments. Rohan, thank you so much for joining us. I wanted to start with you, if you could tell us more about what you do and how does Cambridge Associates approach secondary investments.
Of course, happy to. And thank you, Khaled, to you and the PE Forum for the kind invitation. Good afternoon, everyone. My name is Rohan Dutt. As Khaled mentioned, I'm a member of the Global Secondaries team at Cambridge. I am based in our London office, but my role at the firm is to lead the evaluation, execution, and origination of secondary investments on a global basis. And so over the last decade plus, I've participated in the secondaries market in several capacities on the buy side and sell side for Cambridge as an LP in secondary funds and evaluating secondary managers on behalf of our clients. And I've also worked with many clients to incorporate an allocation to secondaries within their broader private investment portfolios. So Cambridge has consistently allocated to the secondaries market really since the inception of the industry almost probably 30 years ago. We can commit between $1 to $2 billion to secondary funds on an annual basis. And we're also actively deploying into the secondary market on the buy side, having deployed over 600 million over the last 7 years into secondary transactions ourselves. So very much appreciate the opportunity to have a virtual discussion today. I will be in the Middle East in about a month's time, to the extent that anyone in the audience is interested in further discussion on any of the topics we addressed today.
That's fantastic. So just to jump straight to our topic at hand, if you could, not all LPs or investors are familiar with, the secondaries. So if you could just give us a quick description, and also why would institutional LPs seek to allocate in this asset class?
Yeah, happy to do so, Colette. I'd say I probably go longer on the second part of that question, so be warned. But for the uninitiated, secondary transactions involve the purchase and sale of pre-existing commitments to private investment funds from one investor to another. Secondary transactions can also involve the purchase and sale of direct stakes in private companies. I'd say secondary buyers are perhaps best known for their ability to acquire funds or assets at a discounted purchase price below the reported net asset value of these holdings. And mitigating the J curve, I'd say, is another key factor of secondaries. As you all will know, in the early stages of a private fund's investment period, I'd say LPs typically experience a period of negative returns as the fund manager draws down capital for investments and management fees. And so we call that phenomenon the J curve effect. Secondary funds and transactions help mitigate the J curve, since the acquisitions at a discount to NAV typically lead to a write-up of new investments, which results in strong interim performance for secondary transactions and secondary funds. And we call that strong interim performance J curve mitigation. Now, in terms of why institutional LPs seek to allocate to the asset class, J curve mitigation, I'd say, is a key one. But secondary funds also deliver earlier distributions to LPs. You're right. By secondary funds are investing at a later point when they're acquiring an underlying fund, usually in years 3 to 7 of the fund term, when the funds being acquired are often past their investment period and in distribution phase. And another notable attribute of secondaries is the broad diversification that a secondaries fund or even a secondaries transaction can offer to investors in private markets. So a secondary fund will have hundreds, if not thousands, of underlying assets, offering significant diversification relative to a traditional PE fund. And I'd say, this is diversification by sector, industry, underlying strategy, GPs, but also vintage years. And I'd say uniquely, secondary funds offer investors the ability to backfill a portfolio with a range of historic vintages that can be particularly valuable to new investors to private markets during that initial phase of their portfolio development.
And so, how do you see currently the long-term prospects for secondaries? What is your assessment for that?
Sure. The long-term trend is quite clear to us that secondaries are well positioned for continued growth. For context, annual secondary transaction volume has grown from 25 billion back in 2011 to over 100 billion in recent years, including a record $132 billion in 2021. So I would not be surprised at all if 5 years down the road, we're looking at a secondary market that is generating over $200 billion of annual transaction volume on a consistent basis. And I would say there are a few factors that contribute to that kind of forecasted growth. First is the growing supply of assets for buyers to actually acquire. 2022 and 2023, as we all know, are down fundraising years for the industry, the broader private markets industry, I should say. But there's been well over a decade's worth of robust primary fundraising activity across private markets. And I think, well, I know that has led to a tremendous supply of private markets assets, right? There's an estimated $10 trillion of unrealized value across the private markets today. And many market participants believe that figure could grow to 15 trillion 5 years from now. Another factor for growth is the secondary turnover rate, which effectively measures how frequently LPs are utilizing the secondary market by comparing total annual secondary transaction volume with the base of outstanding NAV. And over the last decade, secondary turnover rates have been incredibly low, somewhere between 1 to 1.5%. But even long-term incremental changes in that rate from 1% to 2% will have an exponential impact on secondary transaction volume. So it does appear that the rise of that turnover rate is almost inevitable because we're continuing to see widespread adoption of secondary sales across the institutional investor landscape. And we're not talking about distressed or forced seller situations anymore from 10, 15, 20 years ago, right? Today, secondary sales are a consistently utilized portfolio management tool for all types of investors, really regardless of their portfolio performance or portfolio objectives. I'd be remiss if I also didn't mention the GP-led opportunity either, right? This is a market. Yeah, please.
Yeah. I just before this is what I wanted to ask you, if you could, segment the different categories or the different possibilities for LPs to engage into secondaries, and then it's interesting to go deeper, basically, in the GP-led transaction and their recent growth. Absolutely.
Totally. Happy to do so. And so I'd say, the GP-led market has grown tremendously, right? This is a market that did not exist a little over a decade ago, but last year had over $50 billion in transaction volume. So LP interest transactions are transactions where, as I mentioned, sellers, institutional LPs are selling funds interest. So LP interest in funds that they have committed to on a primary basis. It's a relatively simple transaction. An LP can acquire, or I should say, can sell a single fund or a portfolio of funds to a secondary buyer. And that really is the roots of the secondary industry and around 50% of market activity. As the name suggests, GP-led transactions are liquidity events that are actually orchestrated by the general partners of funds. So instead of the limited partners, right, they are, and I'd say today, they most frequently take the form of continuation vehicles. So continuation vehicles are a form of fund restructuring that involves the transfer of underlying assets from an existing private markets fund into a CV. And so at closing, GPs will transfer underlying assets, sometimes one, sometimes multiple assets, into these continuation vehicles. And it's the secondary buyers that are capitalizing these continuation vehicles. They're also negotiating the pricing of these assets. the composition of the assets to be transferred, and the economic terms and alignment with the GP for the new continuation vehicle. So in this case, original LPs in a private investment fund are given the option to take the liquidity or roll into the CV and extend their exposure to these investments on the same term as secondary buyers.
Okay, very.
Yeah.
No, please go ahead. Continue.
No, I was going to say, alignment is very key here, right? We're not just talking about alignment between the GP and us as secondary investors in the CV. We're also seeking strong alignment with the existing LPs in this fund. So when CA evaluates an opportunity on the buy side here, we're really looking to ensure that potential conflicts of interest are not only identified, but addressed, and that LPs are treated very fairly throughout the process. And so that's very critical to us, and happy to comment on how the GP-led market has evolved to the extent that that's of interest. But
yeah, if you mentioned the size that it has grown into in the recent year, and if we take the entire secondary market activity, how do you see how have you seen it develop during the past 18 to 24 months? What is your assessment on that?
Yeah. So, well, I'll start with GP LEDs, right? So that market has been around for almost a decade, and represented around 20 to 30% of total market volume since 2020. Or I should say until 2020, right? When the advent of single asset continuation funds really led to a surge in activity. And ever since then, GP LEDs have been about half of the market. The last thing I'll say about GP LEDs before we go into the last 18 to 24 months is, the quality of underlying assets and sponsor GPs in these transactions has improved tremendously. So in the infancy of the GP-led market, these transactions involved underperforming GPs that had difficulty fundraising, and they were perceived to be pursuing these fund restructurings as a means of keeping their franchise alive. And they were deemed to be what we called zombie funds. You might recall that term.
Absolutely.
From a decade ago. But there has been a reinvention of sorts, right? Where now GPs, including high quality groups, are utilizing this technology to extend their hold on their best trophy assets in their existing fund portfolios. And so the improved quality of these opportunities has really grabbed the attention of not only the buy side universe and secondaries, but GPs across the landscape of private investment. And I'd say they're attracted to the ability to provide trophy assets with more time and capital to generate more value. But they're also, attracted to providing their existing LPs with liquidity, the option to lock in performance. And that's something that is very attractive to LPs, GPs, I should say, in the current market environment. With respect to the last 18 to 24 months, obviously a lot has transpired over the last 24 months. It feels like it's been 5 years, if I'm being honest. Obviously 2022 kicked off with the numerator challenge for many LPs, and you saw strong outperformance, and the rapid deployment of private markets funds caused many institutional investors to be over allocated to privates relative to their expectations, right? Then you had the correction of public markets, right? And the comparative stability of private market valuations, stability or stubbornness, right? We could call it either. And that resulted in the denominator effect. And I think further exacerbated that over allocation challenge. And then to top it all off, we saw exit activity slow down to a trickle, right? As the progressed. And so private markets were no longer self-funding, as they had been for many years. LP contributions were materially outpacing the distributions that LPs and many in the audience might have been receiving. And I think that created a fundamental need for liquidity across the industry. And so that distribution drought in particular. So with that as a backdrop, 2022 was the second busiest year on record, trailing only 2021. Again, there was $108 billion of transaction volume last year. We saw a return of the LP interest deal, with LP deals representing 52% of total volume. And that's a majority of the market, really, for the first time since 2019. That over allocation we touched on continued to be a key motivator for LPs pursuing sales. Over allocation reportedly accounted for nearly 50% of all LP selling activity. And then the GP-led market, as we covered, $52 billion of transaction volume in 22. We at Cambridge view that sustained momentum of GP-led activity as an endorsement, really, of the market's ability to deliver liquidity in a challenging exit environment, and then that widespread adoption of that GP-led activity that we covered. With respect to pricing, secondary.
Yeah,
Yeah.
on that point, I just wanted to exactly to ask you. You mentioned that discounts on the net asset value. Is it are they all at the same level, or it depends on the GP? What is the pricing level on the secondary market? And in your view, what impacts it the most, or forces larger discounts? Let's say.
Certainly. So I would say pricing is very much asset specific and GP specific entirely. And it also is specific to vintage and asset class, right? So there's the broad pricing that I'll reference is industry level pricing, but there are sort of microclimates of pricing across private investment. And I would say you will see slimmer discounts for higher quality assets. Today, you're seeing slimmer discounts for more recent vintages because you have buyers believing that some of these more recent vintage funds with unfunded will have the ability to deploy in a more favorable investment environment. Generally speaking, this is a market where high quality buyouts will typically trade at 10 to 15% buyouts. I say buyouts generally, high quality single digits. In 2022, we saw a dip in pricing. So that declined to 81% of NAV across all strategies for the year. That was an 11% drop from 2021. Discounts widened throughout the year. And I'd say in terms of macro level factors that influence pricing, I'd say the prevailing belief that private company valuations are inflated relative to public markets. That is one of the biggest factors in the discounts today because GPs are stubborn when they're marking their assets. The delayed portfolio company exits, that has a direct impact on buyer pricing. And I think you did see when there are recession fears, higher underwriting targets. So that did lead to depressed pricing in the end of 2022. 23 started off more slowly. We did see significant bid-ask spreads persist. But today, as public markets improved in the first half of this year, secondary pricing across all strategies went from 81% for 2022 to 84% for the first half of this year. And I'd say buyout pricing went to 90%. Sorry, go ahead.
And are there differences between, let's say, theme-focused GP-led secondaries versus generalist strategies, or it's really as on a micro level, as you mentioned?
It's very much on an asset level basis. I will say sector focused specialists have done very well, right? That's there's no doubt about that. And so I'd say indirectly there's probably stronger pricing than for some generalist funds, but don't get me wrong, some generalist private equity funds have done consistently well and delivered strong returns. So it will very much be on a case by case basis. Yeah.
We talk about liquidity and illiquidity of the market and the nature of private equity, but there's also a continuous discussion around dry powder and the increase in dry powder. So if we look at the secondary market, at which levels of dry powder are we, and how has it evolved in the recent years? And if you can give us a sort of a forecast of how you see it moving forward.
Yeah, happy to. So annual secondary transaction volume again for last year was 108 billion, 132 billion dollars the prior year. If you compare this transaction volume to the amount of dry powder that's out there in the market, there's effectively less than 1 year's worth of liquidity across the private markets today. And so at a market level, this is an encouraging dynamic. We think it bodes well for buyers across the spectrum of secondaries. It's in line, but I'd say a bit lower than historical standards for the secondary market. I'd say it's very interesting. You mentioned broadly in private investments, we when we compare this to global buyouts, for example, capital overhang there is estimated at approximately 20 months before you even account for leverage. But for secondaries, even when you factor in, near-term fundraising at $65 billion, the use of leverage, which we'll estimate at $30 billion, that pro forma available capital is still less than 2 years worth of liquidity. So we think right now that the secondary market is undercapitalized, which is crazy to think about when you see the size of some of the funds that are out there. But very much so, think it's an undercapitalized opportunity in market.
And so, in your view, the global economic condition, I mean, especially, we mentioned consistently the higher interest rates of, showing who can swim and who can't, and in the current conditions. How do you see that affecting the secondary market? And you see these economic or macroeconomic conditions persist on the longer term?
Sure. I wish I had the crystal ball to answer the second part of that equation, but I would say we are factoring that in. When we're underwriting, when other secondary buyers are underwriting, I think you're seeing conservatism in macroeconomic assumptions, and secondary buyers are pessimists either way, and so that is, I think, inherent in our projections. But it's a great question though, because I think as secondary buyers, we benefit from the ability to price in the impact of rising rates during our due diligence process before we commit any capital. So it's a fantastic question because rising rates have a ripple effect, right? When stacked up, they can have a material impact on a PE fund's ability to generate expected returns. And they also impact the timing of those cash flows. So two very critical points for any secondary analysis. And so when CA is considering a buy-side opportunity, it's imperative for us to constantly assess and stress test assets for their sensitivity to interest rate changes. So for all the assets we're evaluating on a bottoms-up basis, we're digging into how valuations and exit multiples will be impacted by rising rates, how the timing of every exit could be affected, since potential acquirers, will be impacted by the availability and the cost of financing. But it's also important to examine fund level leverage and GP's exposure to floating rate debt. And I'd say these are analyses that any good secondary buyer should be undertaking. But I'll add that, as a secondary buyer, Cambridge, as well as other secondary firms with primary capabilities, have the benefits of tracking GPs for years, if not decades. And so as a result, we know how GPs have historically navigated those interest rate fluctuations. And I'll steal your metaphor there, their ability or inability to swim and adapt to changing market conditions. So it's a very important component of our analysis. I'd say you have to account for it in your underwriting as you evaluate the impact to returns for underlying GPs and assets. And I'll also just add, there's a lot of leverage used by secondary buyers out there, right, themselves. When at the deal level, at the fund level, given the increased costs involved, I think there has been less leverage used by secondary buyers, and I would see that coming down. And I think that's led some groups that rely on leverage more heavily to be less aggressive when pricing their bids for LP deals.
And so taking this into account, and whether it's the level of debt or the economic conditions, how does that and how has it impacted the performance of secondaries recently?
Yeah, that's a fantastic question. So I'd say the last 12 to 18 months have really demonstrated the resilience of secondaries to us. And it's too early for 2023, but as the performance is still coming through. But let's take 2022 as an example. The performance data that we have at Cambridge has shown us that secondary funds were not as negatively impacted by the valuation reset or all the broader turbulence that you referenced in the market. And I think that's emblematic of the benefits of diversification, as well as the cushion that discounted entry point provides to secondary investors, particularly in times of volatility. And I'd say, discounts and diversification have supported very stable returns for secondary funds across varying economic cycles. But particularly with secondary buyers that are consistently disciplined with respect to both pricing, but also investment pacing. And I just say for context, historically, secondary funds have produced comparable returns to private equity funds on an IRR basis, with a much narrower band of return outcomes. So median IRR performance for secondary funds is in line with median PE IRRs, but bottom quartile secondary funds tend to generate much stronger performance on an IRR basis than bottom quartile PE funds. And I think that points to those benefits of diversification and that discounted entry point, no matter when you're investing.
Mm-hmm. So you said you don't have a crystal ball, but throughout your role, you've done due diligence on more than 80 funds that resulted in over 10 billion in aggregate commitments from Cambridge Associates clients. So using this experience, what is your outlook for 2024 on both GP-led and LP-led opportunities?
Sure. So I've made all my caveats with the crystal ball, so we're out there. But so far be it from me to make market predictions. But I would say pretty unequivocally, the outlook is bright, right? I would count on another banner year for secondaries, right? So given all the factors we've covered on this call, I would anticipate around $100 billion of transaction volume again. It's already been a very busy Q4 for 2023, and we are already in dialogue with intermediaries about LP portfolios that will come to market in Q1 2024, as well as GP-led opportunities that involve high-quality groups. So we'll continue to see quality flow on the GP-led side because, as we mentioned, GPs are facing pressure to deliver distributions as they gear up for their respective fundraises. And I'd say when referring to a banner year, I'm not just saying that with respect to market activity. It's actually, I think the stars are aligning for a very attractive investment opportunity in secondaries in the next 12 months. So we've covered quality supply on the GP-led side. On the LP side, right, you have sellers and buyers alike recognizing distributions have slowed down meaningfully, right? Muted distribution activity, as we've covered, directly impacts buyer pricing. And so the silver lining here is that in the absence of that liquidity, there are more sellers exploring the market as a means of unlocking some liquidity in their investment portfolios. In order to boost pricing in the current environment, I think a lesson of 22 is higher quality portfolios are being brought to market. And so today, I would argue there are higher quality funds managed by blue chip GPs. There are more of those in the market than ever before. And yet still, sellers remain more willing to accept a discount as a trade-off for access to that liquidity. And so in our experience at CA, we've had an increasing number of GPs contact us directly on behalf of some of their LPs who are seeking liquidity, but they really want everything handled in a quick and discreet process. And for context, these are at $10 to $25 million in size. These are smaller interests than larger secondary buyers really are interested in allocating resources or time to, at least on a standalone basis. But they still involve funds with high quality, mature, profitable mid-market buyout assets that historically commanded single-digit discounts or even premiums to NAV in recent years. But we're coming to the table with double-digit discounts. And not too long ago, we would have been laughed out the room, right, with these type of pricing proposals. Today's market, we're getting these things done, and we're incredibly excited about the performance potential of these investment opportunities. The last thing I'll mention just is historical precedent, right? And history doesn't repeat itself. We all know it can certainly rhyme. And I'd say secondary funds, as I mentioned, have generated consistent and stable returns, right? There's a narrow band of returns across macro environments, as we see in the data that we have at Cambridge. But our data has also shown us that secondary investments made in the wake of market dislocation have delivered compelling performance, and they've contributed to some of the best vintage years. So, with that in mind and all the factors we've discussed, I think there's a lot to be excited about for the outlook for 2024 for secondaries broadly across all transaction types.
Just one last question. Is it, if we look at the type of LPs that are interested in investing in secondaries, is it mostly institutional investors, or do you also start to see family offices and other type of investors being attracted to this asset class?
It's a great question, Khaled. For Cambridge clients, and I'd say for the market broadly is picking up, all types of investors of all sizes at various levels, at various stages of their program development have utilized secondaries, right? Mm-hmm. So early on in some of our client portfolios, within the private bucket, there's a 25% allocation to secondaries, right? Mm-hmm. Given all the features we've discussed earlier, some will ramp that down over time, but I would say secondaries can play a role in any portfolio. And with the advent of GP-led secondaries, I do think some of our clients are viewing that standalone opportunity as really differentiated, almost buyout exposure, right? Buyout-like returns, but on an attractive risk-adjusted basis. So we have seen it from all investors types across geographies, and really across all programs, regardless where they are at their stage.
Great. Ron, I know you have other commitments and you're busy, so I just want to thank you for taking part in this discussion, and thank you for the attendees that joined us, and hope to continue the conversation and hear how things are moving within the secondaries a bit later in 2024.
Likewise, appreciate the opportunity to speak and look forward to continuing the dialogue.